Good afternoon and welcome to the SHEARWATER Group PLC final results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Phil Higgins, CEO, Paul McFadden, CFO, and Marcus Willett, member of the SHEARWATER Group's advisory panel. Good afternoon to you.
Thank you, Alexandro, and welcome everybody to this year's results presentation. We've got a short presentation for you today, which we'd like to get through as quickly as we possibly can, so that we can save some time for Q&A at the end. So just quickly to remind you as to who we are, SHEARWATER Group companies provide cybersecurity technology solutions and professional advisory and consulting services. We do this to help companies to be more secure and compliant online whilst doing business. We have two distinct divisions. We have a software division and a services division. Our services division sell to Fortune companies, both domestically and internationally, and we do that directly. Software division, we actually sell through a two-tier distribution. We have a network of circa 350 plus resellers around the world who actually sell and represent our software for us within country. Today, we're covering around 50 countries, and we do that through circa 90 employees through 5 offices. Now coming to the main event, obviously I'm very pleased to be able to report for the first time ever that we've come in above expectations on both revenue and the EBITDA. 186 new customer wins, 20 new client wins via cross-selling, and some extremely substantial service contracts have all contributed to a year-on-year revenue growth of 13% and an adjusted EBITDA improvement of 19%. And during the year, and Paul will come on to a little bit more detail later on, we're in a very strong financial position after paying off and paying down some residual debts that we had. Just moving on, just to give a little bit of colour about where those revenues came from. On our services side, as you can see there, 40% of our revenues come in from renewals. This is from existing customers that we have where they've placed orders with us previously and they come up for scheduled renewal. We also see 54% of our business in our services division actually came from our existing customers who actually either extended their relationships with us, we won new business inside that customer, or we've been able to cross-fertilise with other parts of the group. And ultimately, we've managed to actually grow our client base by 6% additional new clients. These clients I know it's a small number, but please don't underestimate the quality of that client that actually sits behind that 6%. So all in all, our strength in our numbers this year did come from our services division, and we will give you a little bit of detail as to what's gone on with our services later in the presentation. On the other side of the fence of our software business, where we have our Secure Envoy, progress has been really good this year. Very pleased. Whilst we did have a slight softening of our top line numbers, and we'll give you the details on that. That's mainly to do with a transitioning from an on-prem solution into a more sustainable model of a service-based and cloud-based technologies. We have been busy though during the year. What we have been doing is obviously looking for new methods of revenue generation. We've been busy on the R&D. Our MSSP model is in its final test. What that allows us is to sell our software through to the MSP community, allowing them to rebrand this technology as their own and sell on to their client base. This is a huge step forward. Not many people do this, so we're looking for this to actually provide us with future revenues. Also, from a technical perspective, we've now been able to enhance our identity access management by introducing true location functionality. What this does, it allows us to actually restrict the geographical location from where someone can actually log into your network. So, for example, it could be restricted down to London. So anyone working in London, or if you have your office connection there, you can connect through into your corporate LAN. Anyone from outside London wouldn't be able to. So obviously that strengthens the corporate's resilience against cybercrime. One of the things that we've also been doing in terms of GeoLang, we have been very busy in enhancing the product set. Over the last 12 months, we've been working very closely with a leading client who acquired the software from us. What we've also been doing is actually increasing the features. And what I'm very pleased to be able to report is recently we have got the ability to scan optical character recognition. This is something that's been very, very difficult before. So you take a document, put it on the scanner, and to actually identify sensitive data inside that has been extremely difficult. Images and PDFs and so forth. And what we're able to do now is actually overcome that challenge. All of these new softwares that we've been working on, Paul will be able to talk about the R&D investments in those later on, but needless to say, these will all be out and available later on in the year. And they all contribute to us becoming what we want to be, is a security as a service converged platform provider. And as you can see there from the little table, we have a number of those boxes already ticked, and the boxes where it's got acquired and developed, those present us an opportunity in the future to either acquire a company or to develop the software ourselves. Now, with that, I'm going to pass over to Paul. That's going to give you a bit of a rundown on our historical revenues. Paul.
Brilliant. Thanks, Phil, and good afternoon, everyone. Before I go into a bit more detail on the fiscal year 22 numbers, I just wanted to show this slide, which provides a picture of our financial performance over the past few years. Just started in April 2019 when Phil and myself started working together. Within those first 90 days of working together, we decided the business was in need of reorganisation. And as a result of that subsequent reorganisation, we looked to remove and discontinue some revenue streams that had historically never yielded the required returns. We looked to introduce a shared services function to the group to serve all existing businesses, which would provide commonality of control and also allow us to drive further cost efficiencies across the group. That exercise, once completed, saved around about £3 million of annualised cost savings, and the resulting movements forward has been we've had a much slimmed down group, which is a lot more structured and where our businesses are working together. They know what each other does, and that has allowed us, I'm pleased to say, to deliver profitability improvements at each of the reporting periods up to fiscal year March 22. Okay, as we move into fiscal 22, so this is just a summarised version of our P&L. So the key points to note here is obviously revenue growth of 13%. Up to 35.99 million for the period, and this has been driven, as Phil mentioned earlier, by a strong performance within the group's services division, which has offset some softness within the software division during the period. In terms of margins, we've maintained our gross profit margins at around about 30%, and I'll explain on the next slide some of the dynamics behind how that's been achieved. An adjusted EBITDA of 4.4 million is up 19% on the previous year, and again, the EBITDA margin of 12% is maintained in the period. Other items on the summarised P&L include a disproportionate high tax charge, and I think it's just worth mentioning of the 1.2 million tax charge, 1.1 million of this relates to a deferred tax adjustment, which was expensed during the year, and this is in relation to recent budget announcements to increase corporation tax rates up to 25% in the future. So this 1.1 million is a non-cash item which has been included in the P&L for the period. Obviously, the improvements in trading during the year has resulted in an improved adjusted EPS, up from 10p to 11p during the period. Okay, this next slide provides a little bit more of a breakdown of each of the group's divisions, our services division and our software division. So starting with our services division, as mentioned on the last slide, a lot of the group's revenue growth in the period came from the services division, and more specifically, the security solutions revenue line and advisory revenue lines saw strong performance during the period. In terms of gross margins, the services division saw an improvement from 23% up to 26% during the period. And this improvement in gross margins in our services division has been driven by obviously improved profitability from those advisory revenue streams, which generally yield a slightly higher gross margin than that of some of the other revenue streams within the division. Overhead costs of 3.9 million are ahead of the prior year, and this incorporates additional headcount costs as we look to try and invest into additional sales resource during the period and some additional administrative shared services cost in the year as we've introduced additional departments and functions within that department. Adjusted EBITDA of 4.7 million represents a 52% year-on-year increase and delivers a 14% adjusted EBITDA margin, up from 11% the previous year. Moving on to our software division, it's worth noting that we have seen some softness in top-line revenues within the software division in fiscal 22. And of this £1 million deficit, this can be broken down into three distinct areas. Firstly, we have seen some delay in new product sets coming available, and this shift to the right has resulted in new business opportunities reduced in the period, and that has resulted in circa 300k of the delta that we've seen in the period. A further 300k would be as a result of the impact of multiple year subscriptions, and what these are would be for our on-premise products, whereby we sell a multiple year subscription, say in fiscal 21 for a 3-year period, and this doesn't repeat, and the renewal opportunity doesn't come around till fiscal 24. So therefore, that has created a gap in the renewal opportunity during the period. However, it's worth noting that our renewal rates within our software division have remained stable at circa 80%. So of the potential opportunity of renewals, we continue to see a good level of renewal from our client base. Thirdly, the other parts of the revenue delta has been where in fiscal 21 we achieved a large enterprise deal to a leading high street bank within our geolending products, and this deal, whilst we didn't repeat a similar size deal in fiscal 22, where we are today, we feel this first real enterprise size deal with a client has given us some confidence, whereby this client has been an early adopter. They've worked with us and we've road tested the product set to a point now where we feel very confident that we have a good product that we can go out in the coming years, and we can actually drive sales to other enterprise clients. So this creates a good opportunity for business. Obviously the margins from these types of sales is rich. So again, it provides an exciting opportunity for us moving forward. Gross profit margins within our software division are reduced as a result of some of that top line delta, and obviously some of that being as a result from time and so multi-years that we still have the clients. However, renewal opportunity was not available in fiscal 22. Overheads have reduced significantly on a year-on-year basis. The two main factors here is we have repurposed some of our technical resource, so they're more focused on driving development of new product sets, which has resulted in obviously some savings in the type of business as usual technical spend, and also we have been able to realise some administrative efficiencies during the period. Adjusted EBITDA of 1.5 million is slightly behind the previous year, with the EBITDA margin reduced. However, I think it's very important to mention that as we move forward, we feel we have software products that provide us a good foundation, a good opportunity to see growth in the future years. And again, we have existing clients that we can upsell to, and also with new functionalities coming available, this opens up a market of potential new clients who are looking for some of the product sets that we hope to have available in the coming periods. This next slide provides a summary of our cash flow for the period, and I think it's important to mention our operating cash flows after 2 years where we saw strong cash conversion well in excess of 100%. We did see some unwinding of working capital in the year, and this is predominantly due to timing of year-end client receipts, which have moved from Q4 into the next fiscal year. We have repaid 1.3 million of deferred VAT during the period as well, which is reflected within the operating cash position. Other items on the cash flow statement include an increased investment into our R&D spend, so spending more money on supporting development of our internally developed software products. And in addition to this, we have repaid circa 700k of legacy loan liabilities in the period, which was repaid in advance of this was repaid early. Just before I finish on that part, I have missed off. We still have an unutilized RCF facility. We have a very clean balance sheet. We continue to collect debt efficiently, and where we sit following year end, we feel we have a solid foundation as we look to move forward to drive hopefully organic and inorganic growth.
Thank you very much, Paul, for that. And we'll be able to, no doubt, there'll be some questions queuing up for the finance later on. But before then, I've got great pleasure in actually introducing you to Marcus Willett, CBOBE, who is a part of our advisory panel members at Shearwater. And today, Marcus will be presenting an update on the threat landscape. Now, Marcus comes from a great pedigree, 33 years inside as deputy head of GCHQ. I mean, you can't get anyone with more knowledge than that. Currently, he's held posts across the intelligence community, and currently he has a role as advisor for the cyber of the International Institute of Strategic Studies. And with that, I would like to pass over to Marcus, who's going to give us an overview on the threat environment today. Marcus, thank you.
Thank you very much, Phil, and good morning to everyone. In June, the Biden administration warned that more frequent cyber attacks are the new normal for companies and individuals. They said that the pace is unlikely to slow, and that in today's complex, dynamic, and dangerous cyber threat environment, the answer is that our shields will likely need to be up for the foreseeable future. You'll have seen similar warnings from the UK and other aligned states, almost all of them focusing on the threat of ransomware attacks by cyber criminal gangs and/or the spillover from the cyber dimension to the war in Ukraine. We're consequently in the middle of a seismic shift in cybersecurity's role that began a few years ago from, as one US article put it, an occasional and wonky concern for government and industry, to one that often drives policy in the White House and number 10, and I personally saw that in the Prime Minister's National Security Councils, in Congress and Parliament, and of course among top industry leaders and boards. What sits beneath this? I will cover the two big threats, criminal ransomware first, and then the cyber dimension to the Ukraine war, particularly the risk of spillover. There have been some high-profile ransomware attacks conducted by Russia-based criminal gangs last year and this. Perhaps most prominent was the attack by the Dark Side group that hit US Colonial Pipeline, causing it to shut down operations for 5 days and leading to temporary fuel shortages on the US East Coast. But we've also seen the R-Evil group hit the JBS meat producer and hit hundreds of organizations simultaneously by infecting the US software management company, Kaseya, in what amounted to a complex supply chain operation. And we've seen the Conti group attack the Irish Health Service and Costa Rica so extensively that it declared a national emergency, with the gang rather sinisterly declaring it was just a demo version. But behind the headlines are a host of other victims, large and small. Between 2016 and 2020, the average ransom payment in the US rose from $400 to $315,000 US, with overall payments last year estimated to be $600 million US, 4 times higher than in 2019. Meanwhile, the UK reported twice as many ransomware attacks last year as in 2020, with 2020 seeing a threefold increase on 2019. One study claimed that a third of global companies said they were victims of ransomware attacks in 2021, and not all companies fess up. The number of ransomware incidents per month globally so far this year is reported to be even higher than in 2021. You'll have seen the various measures designed to combat this, from sanctioning individuals, multi-million-dollar awards for relevant information, debates about whether to outlaw the paying of ransoms, an insurance industry grappling with its underwriting policies, to cyber attacks on criminal groups by US Cyber Command and the UK's National Cyber Force. In the middle of it all, Biden confronted Putin on the issue at a summit in Geneva in June last year, after the Colonial Pipeline hack. Subsequently, and in retrospect, probably for their own diversionary reasons, the Russian authorities arrested 14 members of the R-Evil group in January this year. Of course, come the US and NATO response to Russia's invasion of Ukraine, all charges against the R-Evil members were dropped, with the prosecutors allegedly contemplating hiring them to work for the state against Ukraine. On that note, most Russia-based cybercriminal groups pledged to support Russian interests in cyberspace at the outset of the war in Ukraine, adding to Western cybersecurity unease. For the Conti group, though, this backfired spectacularly, since it had affiliates in Ukraine, one of whom leaked the source code for its core program to aid its detection. Ironically, a private pro-Ukraine hacking group called Network Battalion 65 modified the code and used it to attack Russian networks. Indeed, today Russia is probably the most attacked state in cyberspace, with a host of private individuals and groups going after it, with one assessment saying that in March, more credentials were leaked online connected with Russian emails than for any other nation, a position normally held by the US. This has all rather laid bare the miserable state of Russia's own cybersecurity. But the rapid growth of widespread cyber vigilantism, 300,000 individuals doing stuff associated with the war on any one day, of course supporting both sides, is also a worry for Western governments, adding to the risk of unpredictability, spillover, and false attributions leading to retaliation and escalation. But the bottom line on ransomware is that it remains endemic and will for the foreseeable future. Which brings us to the cyber dimension of the war in Ukraine. Firstly, of course, states have been conducting cyber attacks for a long time. Most of it is for espionage purposes, with last year's Russian SolarWinds and Chinese Microsoft Exchange hacks notable recent examples. China especially conducts cyber espionage on an industrial scale. Meanwhile, even states employ ransomware, the North Koreans for financial gain, the Russians and Iranians for disruptive effect. States have also developed and used other disruptive techniques, from the cyber vandalism of distributed denial of service attacks and web defacement to the highly damaging malware employed by Russia against Ukrainian critical infrastructure between 2014 and the present. And of course, states have in the past lost control of such attacks, with Russian and North Korean examples from 2017 causing worldwide damage. Think the Maersk shipping line and the UK National Health Services, two amongst many. All of this has come into play during the Ukraine war. The Russians opened the campaign in a relatively restrained way. Lots of cyber vandalism, lots of information operations, lots of cyber espionage, and the seeding of Ukrainian networks with wiper malware. The notable exception to that restraint was a hack on the eve of the invasion into the European network of the US-owned satellite system Viasat, which carried Ukrainian military command and control. The spillover was extensive, with all sorts of internet users in Central Europe impacted, and, for example, 5,800 wind turbines in Germany taken offline. But generally, Russia did not attempt to disrupt Ukraine's critical infrastructure at the war's outset, presumably trying to keep it intact for its own use in anticipation of rapidly taking Kiev and a quick victory. When the Russians failed to do that, and their focus reverted to supporting the Donbass separatists, they turned to an all-out cyber offensive on all sorts of Ukrainian targets, including critical infrastructure, especially energy grids and telecommunications, using all the tactics and capabilities they had been using since 2014, as well as new ones. This cyber offensive is described as enormous by US officials, and I won't bore you with the details and stats, but just one example: the Russians have penetrated part of Ukraine's electricity grids management system and were planning to activate the destructive malware on the 8th of April until the attack was disrupted. Suffice to say, it is all designed for strategic effect, to significantly disable Ukraine's national capacity to resist the Donbass offensive. Some attacks have got through with short-lived effect, but many more were detected and repelled. Overall, the Russians are failing. The reasons? Tons of support to Ukraine from US and allied governments and agencies in the run-up to and during the war. Likewise, game-changing levels of support from the private sector, like Microsoft, but also considerable Ukrainian expertise. For years, the Russians have been crawling all over Ukrainian networks. So for years, Ukraine has been learning a lot about Russian cyber attacks. And there have been plenty of examples of poor Russian planning and, frankly, operational ineptitude. Whatever, I believe we are discovering what cyber war between two cyber-capable states looks like. It is highly attritional. Defense will win most of the time if the basic tenets of cybersecurity are followed. But much depends on the nature and impact and the defender's resilience in the face of the few attacks that get through. Please note as an example that Ukraine has begun to either shift or mirror the data that matters most to it to cloud services hosted out of country, for example, in Poland. There is, of course, also a huge and all-pervasive online information and propaganda dimension of the war, but that is for another day. All of the above carries the risk of unintentional spillover onto global networks. But I'm afraid the most recent Western government warnings are focused on something else, intentional spillover. The warnings are pretty explicit. We know the Russians have the intent and the pre-positioned capabilities to damage Western critical infrastructure. As a US warning from June makes clear, we know such attacks are actively planned with only the timing of their execution in question. I'll give you one example detected by the US government and cybersecurity companies called Pipe Dream, new malware that could shut down critical machinery, sabotage industrial processes, and disable safety controllers in energy plants, thereby potentially causing explosions with an apparent focus on the production of liquefied natural gas. Well, that is where it was found. The fact that the Russians may deliberately attack the Ukraine's allies, together with the high risk of unintended spillover from the Ukraine war and the rampant use of ransomware by criminal groups, some of which might be in support of the Russian state, is why shields need to be up now and for the foreseeable future, right across the public and private sectors. So that is a picture of doom and gloom, but shields up is not rocket science. It is assiduously implementing basic cybersecurity, like being up to date with patching, using multi-factor authentication, having good password protocols, good network monitoring, engaging staff on the phishing threat, and the like. That will stop the vast majority of attacks. And then it is about planning for those few attacks that will get through, building resilience into networks and data storage like Ukraine is doing, concentrating on the data that matters most to the organization and ensuring robust recovery plans are in place and tested regularly. All that too must become the new normal. And all of that is where the help of a company like Shearwater is crucial. And with that, I'm going to hand back to Phil. Thanks, Phil.
Thank you, Marcus, for that very insightful view on the threat landscape. And as you can see from Marcus's commentary there, where Shearwater and its products and services can fit in. So I want to build a little bit more upon the strategic direction of the company in terms of where we're going. So all the bullet points there, 1 to 5 on the right, on the left-hand side, have already been played out. We're currently delivering organic growth in sales. Our revenues are up, and but we're not stopping there. Obviously, we're going to continue to drive on new territories, going to continuously to develop new service offerings and product set, and we will carry on with our cross-selling and expand accordingly. We're also going to be adding this year with our strengthened balance sheet. We'll be able to afford more in proactive sales campaigns and marketing. So we're going to be looking to see to push our brand and our products and skill sets more internationally, not just our domestic markets, but we're pushing this out through our reseller channels, and we're trying to engage the whole community to actually help us build our sales pipeline. One of the key components of our group is obviously to acquire companies, and this now comes on to our key focus for this year moving forward. We have got 2 divisions. We have a software division and a services division, and we're looking for acquisition in both. We're looking from a software position where we can actually buy technologies which will fit on our existing platform, and or technologies that will sit alongside our platform. What we also have the opportunity on our services side would be to consolidate the market space, and there we'll be looking for a consolidation where we'll be acquiring additional customers to actually fit in to our group, which will allow us obviously to increase our cross-fertilization. Moving on. There we go. Just to look forward, current trading position at the moment, we're in line with management expectations, so we're very pleased that Q1 has started off so well. The enthusiasm of the staff, the teams, the inquiries are up, the activity is up, the bid response is up, and we're hitting the Q1 expectations. We can already see in Q1 14.5 million revenues ready to be deployed and received during this year, which is quite early on for us, and it's quite a sizable number for this stage of the game. Obviously, we are tail end heavy with our revenue streams, but we do see that as a good indicator moving forward. And with our newly established M&A committee, it now allows us to actually focus on the M&A activity. So a lot of that activity has started now. We do have a pipeline. We are already engaging in conversations with companies. We do review all sorts of companies. We do, however, have an extremely strict criteria. And with that, what we're looking at is to make sure that whatever acquisition we make fits our organization. It is earnings accretive, it's profitable or near term to profitability. We want to make sure that the acquisition works well for all stakeholders. So obviously the opportunities inside the group. We're obviously going to look to actually try and drive that, continue to drive that organic growth. We're going to look to actually improve our product sets, increase the features on our software to allow them a growth in our recurring revenues. Our software is currently circa around 80%, and we obviously would like to improve that. And as we bring new features to it, it allows us to upsell to our existing community, generating additional revenues and income, and also make our product more sticky, meaning that more clients will stay with us and renew with us in the years going forward. Obviously, what we're looking to do is build out new services as well. So what we'll be seeing is more services being offered from a collection of not just an individual perspective from a group company, but we're bringing some of those together now where we're representing each other, and we're looking to try and take more of those revenues off the client desk. Before, historically, we would knock on the door and we would sell one of our products from one of our companies, but now obviously with the cross-fertilization, it's allowed us actually to take more revenue dollars out. We're incentivizing the team to do so. So it's very active, very proactive, and we're reporting on that as we move forward during the year. Obviously, we're looking to increase our geographical reach as well. What we want to do there is we are recruiting internationally, not just domestically, and we're also expanding. We've expanded into Holland to assist in the development of client base for Brookhaul Solutions. We're also doing expanding into Ireland for Pentest to allow them to capture the market there, but also to recruit. As we look at the acquisitions, some of those will be international, particularly on the software side. There's not many software companies in the UK that are where we would like them to be in terms of the price point. So it does mean that we do have to look further afield, but we're not frightened about that. We will embrace that. We will see the opportunity to actually expand our geographical location at the same time. And with that, I would like to conclude that we're very pleased, obviously, with today's results. We've come in above market expectations. We're very pleased with that. We've got a great team, and I would like to thank the team. And with that, I'd like to pass back to Alexandre.
Phil, Paul, Marcus, thank you very much for your presentation. And if I may just ask you to bring your cameras up for the Q&A, that'd be great. Ladies and gentlemen, please do continue to submit your questions just using the Q&A tab situated in the right corner of your screen. But just while the company takes a few minutes to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. We've received a number of questions today from investors, and I'd like to thank all the investors for submitting their questions today. I just want to start off the Q&A session with this question, which asks, what type of M&A opportunities are you looking at, and is there anything in the pipeline?
Right, let me just build upon that a little bit. We've recently established a M&A committee inside the group, chaired by our chairman and attended by Ned's and Paul and myself. And what that allows us to do is now focus. Now we've got our organic play working. It's allowing us to actually focus on our business of M&A activity. On our software side of the company, we can buy tactical base companies, which are small, which could be pre-rev. What we're interested in there is the technology itself to actually fit that onto our platform. However, we're also happy if the accretive values of the target are correct. We're happy to acquire a company that would sit alongside or even sit on top of our current platform and allow us to expand. Our point is we're looking to drive that service of that software offering to address the opportunities within the market. On the services side of the business, it's very much about market consolidation. We'll be looking for companies that we could actually bolt on to our existing portfolio of service companies. And with that, there's a very active pipeline in that we're reviewing. During COVID, we did see all sorts of companies, and I'm glad to say now that we're now starting to see some more quality companies come through. And with the working committee, it allows us the time to actually focus and actually drive those acquisitions, hopefully through to completion.
That's great, Phil. The next question here reads as follows. Can you please provide colour on the increased accrued income at year end? Has this now been invoiced and how much has been paid? Maybe that's one for you, Paul.
Yes, of course. So obviously Q4 historically has always been a busy period for the business. Pleased to say of the 14.8 million accrued income number, circa just under 13 million was billed in early April, with around about 30% of that number's has been paid. It's worth mentioning Q1 cash has been in line with plan as well.
Perfect. Thank you very much, Paul. The next question here is from Simon, who says, having just touched on the increase in the potential for significant cyber attacks, particularly with the current Russia-Ukraine conflict, what is the size of the opportunity here for Shearwater Group, and who have you offered your services to?
Maybe I can help with that one. So it depends. If you Google IT security, I think you get about 8 billion hits on Google. The market's huge. When you look at some of the finances behind that, they estimate the market anywhere between 130 to 180 billion, and it's growing. In the UK, some of the conversation sits around 7 to 9 billion pound mark, and in that, and that covers the whole breadth, you could say, of that cyber security space. Now we're part of obviously a segment of that. We don't do it all. What's addressable for us is that would vary from our authentication space. That's probably looking between globally, I would say that's a $10 billion market space. If you account for authentication all the way through to PAM, into CAS, into IGA, and so forth, the whole suite, it's quite a sizable space for us. In the UK markets, we could be looking at circa. It's very difficult to say. You'll be looking at a circa $1 billion market space there. And when you look at the services side, once again, as people migrate from an application or an appliance-based computing into a more software and service-based computing, we're seeing obviously those service revenues, there's an opportunity for those to grow. We're seeing a lot more software subscription, a lot more as a service coming available, more cloud-based. So obviously we expect those to grow. It's very, very difficult to actually say what that's worth. Globally, I've seen numbers in excess of 30 billion.
Thank you very much for that, Phil. Next question here from Robert M. Thank you for your question. The two largest customers account for an aggregate 59% of group revenues. Can you share any thoughts that mitigate this concentration risk, for example, single or multiple contracts, 12 months or multi-year duration, etc.?
Okay, I think it might be another one for me. So yes, we do have some large customers, and they do like our services, and they keep on buying, and we don't stop them. We do have large frameworks in place which would sit up above all of the subcontracts. So below the master framework agreements, which some of them are international by their nature, we have multiple new other contracts which exist and work. So at any one time, we're not dependent upon any one contract. These contracts move in and out as technology gets refreshed. We will be replacing it with new ones. New technologies come available, and they'll always be competing. So we do expect some movement inside those clients on a year-to-year basis. We also do expect, because of the type of technology we get involved with, a high recurring rate of repeatable business. Because it's specialist technology and it's not generalized, what we're seeing is that we do have a long-term sticky relationship with the customers. So those frameworks get very, very big. The contracts below them are quite large. Does that answer all the questions? I don't know if Paul, if there's anything more you want to add on that in terms of what the concentration has moved from.
I think probably just the other thing to bear in mind, just to echo your points, Phil, around obviously the master services and then multiple contracts that we have in place. I think also the nature of what we sell, it's not nice to have. A lot of this stuff is stuff that clients need to have. And I suppose just the last thing is, as we've added new clients into the group, this will continue to look to dilute that concentration in the future.
Thank you very much for that. And Phil, another one for you. John asked, did you say that Q1 revenues are circa 14 million?
Yeah, so no, it's Q1 revenues are not 14 million. What we see is the visibility of repeatable opportunities coming along. That currently sits at 14.5 million. So what we see is, as we go through the year where we've got multiple year contracts, technologies that get refreshed, the software licensing that gets renewed, all of those types of things, bring all that together. They present themselves as an opportunity for us to renew. That this year is quite high at 14.5 million. So that's opportunity that we're seeing. Obviously, we still got to build upon what we did last year. But that's a good start to actually sort of see those types of revenues numbers already in the Q1. But that is not the number that we have delivered in Q1.
Thank you very much. Got another one here from Paul B. Is acquiring the best focus to rebuild shareholder confidence / value? Would need to find immediate earning enhancing deals. Are these deals out there?
Yes, they are. If you go pre-rev, if you're looking at technology, bearing in mind, over the last couple of years, we have spent a couple of million sterling on R&D. We've been focusing heavily on making sure the product set works and it's right. It's enterprise grade. We've increased the features. And one of those features is that we built a platform. And this platform is currently being serviced by some of our technologies, and there are opportunities to add additional technology into that platform. Those types of technologies can be pre-rev, because what we're after there is the tech. We don't necessarily need a software house that's got 20 years trading history, where the acquisition costs will be extremely high. So yes, we do have an opportunity there. But at the same time, if we do find the right type of company in the software field that we can demonstrate true shareholders' value, true accretive value to the group, and then they will become a target. And we will obviously be looking at those types of companies as well.
Staying with the software side of the business, we've had a question which asks, how does Shearwater compete with the bigger players in the market?
Well, it's a David and Goliath situation. We do, obviously, we compete against on the global stage. We have global customers. We have some of the most prestigious brands that you can imagine come to us, and they've been doing so for long term. And we have some relationships which extend beyond 10 years. So the quality of our service is one thing. Also, the diversity. One of the biggest companies that the hackers go after is Microsoft. Everyone's got it. So if you then start deploying holistically and start overlaying with other technologies, more specialist technologies, our Secure Envoy, they focus in one area of the business and they're experts in it. And that gives comfort to some people. Our service that we wrap around it allows more personal delivery. And the same with our specialist solution side. We have to compete against some very big players. Now, a lot of our channel that we come across, the way they actually deliver is on a 30, 60, 90 reward basis. And that puts them at a disadvantage. The types of technologies that we get involved with, there's not many resellers involved. There's quite unique. They're very specialist. They're big end. They're high value, good double-digit margins. And with all of that, what it allows us to do is be specialist. And those specializations now are becoming more in demand as compliance and security gets more complex and more demanding on the business. And so we actually have a role to play, and we advertise ourselves into that space.
Perfect. Thank you very much for that. And the final question here is, how much of the legacy loan liabilities are left to repay?
Paul?
I can say this one. Of this, the answer is 0. So during the year, we repaid 700,000 of legacy loans which related to the Pentest acquisition. Those loans were repaid early. They weren't due for repayment until fiscal 23, and an opportunity came available to repay them, and there were some benefits in terms of interest savings, etc. So yes, they were repaid, and yes, no legacy loans.
Phil, Paul, thank you for that. I think you've addressed those questions you can from investors. And of course, the company will review all questions submitted today and will publish those responses on the Investor Meet Company platform. We've just had one more come in. How does Shearwater attract staff in the current market, and are there plans to increase employee numbers?
Okay, so just go back a little bit into the start of COVID. What we chose to do as an organisation is not furlough anyone. So during that period, we, like everyone else, we worked from home. We kept all the staff on. We did obviously have the cost of consulting, but without the opportunity of the revenues coming through. But as a group, the stability of the group would allowed us to actually still deliver on our EBITDA numbers and retain our staff. That year, I'm afraid to say we didn't offer pay rises out. However, what we have been doing, we've enhanced our salary package. Pay rises have been issued to try and meet some of the demands of increasing inflation. We have a more flexible working environment at the moment. Obviously, we're in this new hybrid mode, and it seems to be working well for us. So what we offer our staff is more flexibility. We believe that we're delivering our salaries with inside the higher end of the market rates. Our benefits packages that sit behind it are continuously getting reviewed, and at the moment they offer all sorts from share option schemes, save as you earn schemes, pension enhancements, and down to the basics of cycle to work and all sorts. So I like to think that we're doing as much as we possibly can on that. We're still exploring more. Hopefully there will be some let up from the government at some stage that we can deliver even more. But today we also expand beyond the UK market. We also look at internationally for staff, where labour rates could be more advantageous for certain jobs and certain functions. We obviously look to expand into those areas and bring those staff remotely in and connect them into our network, which will allow us to obviously take advantage of that as well. So we're doing many things to maintain an equal balance. We've improved our efficiencies. We're more focused in what we need to deliver. The people that we have are a great team, and they're the ones who I need to thank for today's results. They did it, and we have the capacity to do more. And we also have got an expansion plan in place to increase our headcount, especially around sales and marketing, and obviously on consulting delivery. So with all of that in place, I like to think that we're a good employer, offering more choice, more flexibility, and a decent wage at the end of it.
That's great. And just before redirecting investors to provide you with their feedback, which I know is particularly important to the company, Phil, the last thing to do is, could I just ask you for a few closing comments?
Certainly. Well, first of all, thank you very much for everyone listening today and joining us. Today's been, obviously, despite all the headwinds that you know about, from Brexit to COVID to the war to even the chip shortage that's been in the news. We came in above expectations, both on revenue and an adjusted EBITDA. We've done what we had to do on that, and it now allows us to go and do the things that we want to do. We want to grow also by acquisition. The cyber market space is growing. You heard from Marcus there. It's the numbers that you Google, it's not conclusive as to the size of the market space. The only thing I can say, the numbers seem to be getting bigger every single year, be it attacks or be it the cost of recovery. And we fit in that space of actually helping companies defend and prevent the daily leakage, the security breach. And as regulations and the law tightens up, this is going to become more important to industry and individuals. We are all going to be affected by this at some stage. All companies will get affected at some stage. And it's about the recovery. And that's what we do. We help companies recover. We help advise them. We help test them to make sure they're solid. We provide them with technology, homegrown, which is very, very margin rich. And also we bring together specialist solutions. We have a long-term customer base. We have got a very big blue chip client base. And on top of that, we've now got a very good, strong financial base to work from. So we've got some great successes. We've now got a committee in place to focus on around acquisitions. We've been reviewing, we've been busy during the last couple of years looking and reviewing. We're now seeing some clarity in that space, and we'll be looking to actually close them. So you have choices where you buy your stock. I'd like to think that the cyber market space is an exciting one. It seems to be a growing one, and we're in that space. So I would like to think that you would also consider us. Obviously, on top of that, we've got there's various reports and notes out there, and I think you'll find that later today it may already be there, but on our website you'll see the most recent note, which was published this morning from Progressive, and you'll be able to read their opinions and their viewpoints about the company, our achievements, and the direction in which we're going. And I think that really sums up where we are, and that just leaves me to thank my panel members and the company for the contribution they've made in getting the company to where it is today. Thank you.
Phil, Paul, Marcus, thank you very much for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of SHEARWATER Group PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.
Thank you.